welcome. You're watching the Business Today show. I'm Sakshi Patra. First up, the top news that we are tracking tonight. It's bad news for the Indian economy. Skymet predicts below normal rainfall this monsoon with a chance of 20% drought. Market indices edge up higher to close in the green for a 6th consecutive day. Sensex up 14 points, Nifty up 25 points, led by gains in auto, tech and also metal shares. An exclusive conversation with Arvind Sanger of Geosphere Capital says he is becoming a fan of gold investments for the first time in 15 years. Cautious on equities. Finance Minister Nirmala Sitharaman begins a week-long visit to the United States to attend the spring meetings of the World Bank and IMF in Washington, D.C. RBI Governor to join her for a meeting of the G20 finance ministers. Singapore's sovereign fund Temasek buys a majority stake in Manipal Hospitals, owns a total of 58% after a $2 billion deal. Founder Pai family turns minority shareholders. Straight on to the top story then. There's bad news for the agriculture sector this year. Skymet, a private weather forecasting service, has predicted below normal rainfall this monsoon. The weather agency says India is likely to receive 94% of the long period average rainfall during the June to September period. According to Skymet, there is a 40% chance of below normal rainfall, also 25% chance of normal rains and a 20% chance of a drought this monsoon. The worst hit areas would be the northern and the central parts of India. Skymet has also blamed El Nino and Indian Ocean Dipole for these conditions. The government-owned IMD, the India Meteorological Department, is yet to give a date for its first forecast on the upcoming monsoon season as well. And we are now joined by GP Sharma, President Meteorology and Climate Change at Skymet, for more on this. Welcome, sir, to Business Today TV, and thank you so much for taking the time out for this discussion. Well, these could be the first signs of worry. In fact, the latest reports that you have put out. Could you help all our viewers first understand what exactly do you mean by normal rainfall and normal monsoon this season, and also what exactly is El Nino?
Yeah, Sakshi, given a choice, one would like to break good news with the media, but somehow it is not a very pleasant one this time. We enjoyed good monsoon, above normal monsoon for the last consecutive 4 years, and after that, and now this El Nino, which is generally, it's taken as a spoil sport as far as the Indian monsoon is concerned. More than one occasion, it has corrupted our monsoon, and there are many instances, and particularly the one which comes after having La Nina, that becomes a little more scary and dangerous, which is the case this time. So El Nino, as you asked, it's a basically warming of the Pacific Ocean, which is far from us. You can call it as a teleconnection. That warming of the Pacific Ocean as compared to what we have in the closer home, that is what gives rise to the El Nino conditions. Yeah. And these conditions, they are linked with having below normal or subpar monsoon over the Indian subcontinent. Almost about 75–80% of the occasion in the past, as per the records, that is linked with the below normal or drought. You see, Skymet has given a forecast now, 40 plus 20, 60% chance combined below normal plus drought. Okay. It is still a little early, though the monsoon is yet to take almost about 45 days plus to reach the mainland Kerala. But then the initial indications are that El Nino is growing. It should be coming up right at the time of onset of the monsoon and then growing thereafter. Particularly the second half, I look at a little more scary than what we start with. It may make a mild start, all right. Means June may be a little kind to us. It could be some decent rains we have. But as we go through the season, I'm afraid the rains are going to become few and few, lesser and lesser, and inadequate for most parts of the country in the subsequent months. Yes.
Right. Exactly, Mr. Sharma, and that's what we wanted to understand from you as to how big a worry could this be for India and the Indian economy. What does it really mean, first of all, for the food grain production in the country? Now, as we remember that, farmers typically start planting summer sown crops from June 1st when the monsoon rainfall usually hits India. Now, plantation then continues until early August as well. And in case you're saying there are higher chances of El Nino hitting, what could this really mean for food production then?
It's a dichotomy for the farmers. Okay, they have to plan well in advance. They have in mind the crop cycles also, short cycle, decent cycle, or moderate cycle of the crop. But then the different types of crop, the different type of irrigation is needed, different type of the water levels are needed, particularly as compared to what we have in Rabi. Possibly, I think Kharif needs more water, these crops. You take the case of paddy, it needs more water as compared to what we have in case of wheat. So, and particularly the worry is the rain-fed areas are large in our country, particularly the central parts of the region, that is Maharashtra, Madhya Pradesh, even I will count Gujarat in that. These are the states which are highly dependent on monsoon rains. Rain-fed areas are large, unlike northern parts, Punjab and Haryana, where I feel they are a little better off as far as the other resources are concerned. But then that also doesn't absolve even those states also. They can't also live through the weaker monsoon as such. But then the worry becomes large because food production, obviously, it's a huge sector. Agriculture is a huge sector, and economy based on that, obviously, it takes a beat, a big bash also. Okay, so that is there on the card, and since it is happening after 4 years of having a normal monsoon, worry is becoming a little bigger, though it's initial forecast now, because as you go closer to the event, the forecast tends to become a little better, but I don't see anything happening good in the coming months. To start with, we take this as a real scare that the monsoon is going to be weaker during this season.
Absolutely. Well, thank you so much, Mr. Sharma, for sharing with us and all our viewers all these insights about the predictions going forward as far as monsoons are concerned. After 4 years of consecutive above normal rainfall, this could be a well challenging year because of the threat of El Nino rising right here. There could be challenges on the food production part, and therefore the impact on price rise going forward. Challenges for the farmers and challenges for the common man do remain going forward as well. But many thanks for being with us, and we shall continue to touch base with you to understand more about the insights from SkyMet going forward as well.
Thank you, Sakshi. Thank you.
All right. We do have definitely the chances of El Nino coming and hitting us, and that could be a big challenge for the consumers at large, because that would mean elevated prices for your food items going forward from here. However, in the short term, inflation is expected to moderate a little bit. The CPI figures for March are expected to be announced on Wednesday, and a poll by Reuters estimates that it could be around 5.8%, and this is significantly lower than the 6.4% of the figure clocked in February. The report expects a significant moderation in food prices due to falling vegetable prices. However, surging crude oil prices could definitely make the relief short-lived, and inflation is expected to rise again, therefore, in the coming months as well. On to the performance on the D Street then. Benchmark indices settled marginally higher amid a volatile trading session in the equity markets, taking their winning run to the 6th consecutive session. The domestic bourses stayed in the positive territory, led by gains in realty pack, in automobiles, technology, metals, and also some of the energy stocks as well. An uptick in Adani Group stocks also helped the indices to close in the green. However, weakness in banks, financials, and consumer goods did limit the gains. The 30-share BSE Sensex pack ended up just 14 points to close the day at 59,847, while the broader NSE Nifty index moved 25 points higher to settle the day at 17,624. On the list of the gainers, we had Tata Motors, ONGC, Adani Enterprises, Grasim, and Wipro up in the green. On the list of the laggards, we had Bajaj Finance, HUL, Asian Paints, Tata Consumers, and IndusInd Bank. Will this year be a good one for investors, or will recession fears loom large on markets? Where will investors make more money? In commodities and gold, or in traditional equities? Earlier in the day, I spoke to Arvind Sanger, Managing Partner, Geosphere Capital Management, to find out what should be the strategy when it comes to deploying idle cash in this year. Here's an excerpt of this conversation. What are your key expectations as far as the central bank's action on rates are concerned right now? There are a lot of changes that are happening. On the one hand, we saw the OPEC Plus moving to cut the production levels. That has stoked some inflation fears. Yet again, perhaps fears of aggressive rate hikes continuing. In case that happens, would that increase the chances of a deeper recession coming in?
Well, I mean, I think, yes, there are many deeper recession. It's hard to say how deep the recession, but there are three headwinds, right? One is that Fed is going to keep raising rates because inflation fears are not going away. Second risk is related to the banking sector. Some of the recent turbulence we've seen is going to cause more bank lending tightening, and that will add additionally to the headwinds to the economy. And the third is is inflation going to prove, despite all these efforts, more stubborn, and OPEC action on oil is going to give that. So those are all three risks, I think.
Right. In the Indian context, we've seen that in FY23, it was the domestic investors that kept the flag sailing high. The FIIs, were largely net sellers for the second consecutive year, although the sell-off really lessened to about 40,000 odd crore rupees. But it was the 2.5 lakh crore rupees pumping in by the DIIs that supported the market sentiments. I want to ask you, will the FIIs return to India in FY24? What's your sense?
I would very strongly expect so, because if you look at the forward curve on the rates as far as the Fed funds expectation, the expectation of the market may be a little too optimistic that rates are going to be cut starting this summer itself. But I do believe that we are towards the end of the rate hike cycle. And once you start to get some relief, look, right now, people are looking at the fact that they can put money, in risk-free assets and get reasonably good return without taking a lot of risk. But I think as the rates start, subsiding, risk appetite returns. And when risk appetite returns, people will be looking for where the growth is the best. And I think India definitely presents, one of the shining beacons in global growth outlook in FY24 from an Indian context. And therefore, I think that as risk appetite starts to come back, that'll be one of the big factors that will drive fund inflows into India, in my opinion.
Right. Again, for the Indian context, how would you really advise the small retail investors to now really approach their investments, be it to equities, be it to the other asset classes? On the one hand, we are seeing gold marching ahead to its lifetime highs. We are also seeing these macroeconomic uncertainties weighing on the kind of impact that they would have on the markets, especially the benchmark moves. So the retail investor is really thinking, if I'm only going to be making just about 3 to 4% on the benchmark or index level, whereas when you talk about the fixed income options, they're actually giving you, with lower risk, about a 7-8% kind of interest rate. Why should you actually take that risk and put your money in equities? What would you tell them?
Well, I think it's a good question because clearly the attraction of the fixed income side of the market has increased, and therefore the hurdle for equities has increased, and therefore you have to find companies with PEs attractive enough and growth attractive enough that it gives you returns. I don't think you can make a big index call and say index will be up 15-20%. It's possible it'll be up that much. We would hope as the earnings cycle recovers that will happen. But let's be frank, some of the index stocks are not trading at super cheap valuations, and in a high interest rate environment, value, I believe, does better than some of these growthier, more extended valuation companies. So my advice to investors would be to look for good values, good managements, solid balance sheets, and good growth stories. And I think there are plenty in India to be found in the mid-cap space, and even in some of the large cap space where I think the cycle is turning, and there are opportunities to invest in some of these companies.
So where exactly in the Indian context are you really looking at value emerging at this current context? And what about the valuations overall of the Indian markets? We were trading at higher valuations earlier. That was a worry point. Right now, what is your sense?
Well, I mean, I think the valuation are also, fortunately, unfortunately, if interest rates in the West start going lower, then then the P expect the willingness to pay higher P's goes up. So it's one of those paradoxical things that lower interest rates will drive willingness to take more risk, and therefore I think that in terms of, you asked me valuations where they're emerging, I think some of the globally exposed companies which have gotten hit, whether it's the IT space or otherwise, are attractive. But there are some domestic industrial stories, domestic real estate. There are specific bottom-up stories. We think the hotel and travel sector is going to continue to do well as people go out and travel more and continue to. That's a growth industry for India, and so we're looking at cyclical industries where there's not a lot of new supply coming on.
Right. Where are you looking at leadership really emerge in terms of sectors in India?
Well, look, banking sector, financials are always an important part of the economy. And the Indian banking sector, unlike the Western banking sector, has come through a significant bad debt cycle. And having come through that cycle, the Indian sector is much more able to participate and to provide the loans needed to grow this business. So therefore, the Indian banking sector is on the other end of the spectrum compared to a lot of the banks in the West, which have come through a multi-year boom and now going into a bad debt cycle. The Indian banking sector, I think, is in great shape. So I think that'll definitely the financial sector will definitely participate. So in terms of leadership, one of the sectors that been missing last year, IT, could be interesting this year because everybody's worried about a recession. That's in the stock prices, so that could be an interesting, because I think there's a multi-year theme in which these IT companies will play. That could be another sector. But I think domestic power, domestic real estate, domestic infrastructure, people who benefit from that in providing the equipment and services and all of that, those could be winners too.
Right, absolutely. I understand that as well. I wanted to understand from larger perspective of FY24, which are the markets that you believe in the pecking order would emerge as leaders in FY24?
Well, look, I think the U.S. market is probably going to have a struggle. I'll say, well, one, it's not a market in terms of a physical market, geographic market. But I think one thing that is becoming very interesting to us is gold and precious metals. And I think that's important for Indian investors who have always had a love for gold to keep in mind. I think that, the dollar is clearly looking to us like there could be downside if Fed cuts rates. And gold is one of the places where we think investors are now starting to gravitate to, and therefore we think that gold and precious metals could be another interesting.
The Singaporean investment firm Temasek has now acquired a majority stake in Manipal Hospitals, one of the leading healthcare providers in India. The deal, which is estimated to be worth around $2 billion, will see Temasek acquire a majority 57% stake in the company. The massive deal values the hospital chain at around 40,000 crore rupees.
One of the largest hospital chains in the country, operating a network of 29 hospitals in India, and also one of the biggest medical colleges in the country. Manipal Hospitals has been taken over by Singapore's sovereign fund Temasek. The fund, which already held 18% stake in Manipal Health Enterprises via a subsidiary, bought another 41% stake, making it the Singapore company's largest acquisition in the Indian healthcare space. According to reports, of the 41% stake bought, 11% is from TPG Capital, which held 22% of the hospital chain. The government-owned National Investment and Infrastructure Fund has fully exited by selling its entire 8% stake. The rest is from Ranjan Pai family that has sold 22% stake, lowering its own holding in Manipal Health to 30%. The deal values the hospital chain at 40,000 crore rupees. Manipal currently has 27 hospitals across India, serving around 4.5 million patients annually. The chain is around 10,000 beds. The group has expanded rapidly in the past few years. In 2021, Manipal acquired 11 hospitals of Columbia Asia for 2,100 crore rupees. In the same year, it bought Bengaluru's Vikram Hospital for 350 crore rupees. Last year, it acquired majority stake in diagnostic company Medsys Path Labs. There's been consolidation as well, with Manipal selling its only overseas hospital, Manipal Hospital Klang in Malaysia, for 700 crore rupees in April 2021. What Manipal offers Temasek is a great deal on a silver platter. The group is one of the top healthcare providers in India. It has a pan-India presence strengthened by recent acquisitions. Each of its branches are NABH, NABL accredited. Importantly, the chain has predictable cash flows and caters to high healthcare spenders as well. Interestingly, the acquisition of a giant hospital chain by a private equity company has not surprised many. Companies like Blackstone, KKR, Warburg and Carlyle have been picking up healthcare assets across the world. Even Temasek is already an investor in Gurugram's Medanta Hospital and Kolkata's Medica Synergy. Bureau Report, Business Today TV.
On another news on the deal street then, Bajaj Auto has taken over sales and marketing operations of Triumph motorcycles in India. The deal will see all 15 existing showrooms of Triumph being taken over by Bajaj Auto, making it the fifth vertical in Bajaj dealerships. The company already operates separate 2- and 3-wheeler businesses as well as dealerships under Bajaj Chetak and KTM brand names. The number of showrooms will be expanded to 120 cities over the next 2 years. The two companies will also collaborate to build the mid-size bikes, which will be made at the company's Chakan plant as well. The first joint venture bike will be out this year. Well, the start of the new financial year also marks the time to start preparing your income tax returns for the previous year. One of the most important things for you to avoid is attracting the attention of the income tax department and a notice. Now, we are joined by Tina Jain Kaushal, editor Money Today, who tells you what really attracts the attention of the department. Tina, there are a number of reasons for receiving an IT notice. Now, what should an income taxpayer do to avoid them in the first place as well?
Receiving a tax notice can be a daunting and unpleasant experience, leaving many wondering what to do next. Broadly, there are main 5 reasons why a taxpayer may receive a notice from the Income Tax Department. First is mismatch with Form 26AS or Annual Information Statement. A mismatch between the TDS stated in your ITR and Form 26AS can lead to a notice from the Income Tax Department. To avoid any such discrepancy, it is essential to cross-check it in Form 26AS and Annual Information Statement while filing ITR. Second reason can be a high-value transaction. This is because your high-value transactions are shared by banks or other third-party sources with the Income Tax Department. If these details do not tally with the ITR of the taxpayer, one may receive a notice under Section 142, subsection 1 and Section 143, subsection 2 for additional information. Third common reason is set-off of refund against the old tax demand. The Income Tax Department has the power to set off refunds due against any outstanding demand, and there is no time limit prescribed for issuing this notice. Here the tax officer issues a notice under Section 245, providing an opportunity for the taxpayer to file objections if any. Fourth can be non-filing of income tax return. The Income Tax Department conducts an e-campaign to notify taxpayers who still need to file their ITR for a specific assessment year. Fifth and last reason for notice could be defect in the income tax return. This is a system-generated notice under Section 139, subsection 9. You would receive it when the tax department encounters a defect or an error while processing the income tax return.
That's right, Tina. I mean, like, those are all the points that one must remember to really do as a prevention of attracting the IT department's eye on our own tax paying as well. But if a notice has been received, then what can the taxpayer do to resolve the situation?
If you receive a notice from the Income Tax Department, it is essential to understand the reason for the notice. Once you understand the discrepancy, you need to respond to the intimation, for which you need to visit the Income Tax website and click on the tab stating Response to Outstanding Tax Demand. If you agree, pay the demand raised, otherwise you need to give reason why it is incorrect. The important point here is you should carefully review the notice and if needed, seek guidance from a tax expert to ensure that you respond appropriately.
Well, thanks a lot, Tina, for all that information. Definitely news of use to all the taxpayers out there. But these could also be the worst of the times to join the information technology industry as well. Adding to the daily layoff announcements is the fast adoption of artificial intelligence in the IT processes. While the impact on the seasoned IT employees is still to be seen, freshers are already facing the heat of this new technology. Several studies do show that AI-integrated workplaces will reduce the need for entry-level workers without compromising on the efficiency and at economical costs to the company as well. Business Today TV's Akansha Chaturvedi now joins us to understand why freshers are at the receiving end of the AI juggernaut. First of all, Akansha, if you could help us understand what are some of the factors that are making current times tough for freshers to enter the job market?
Well, like you just said, major big tech companies like Google, Microsoft, Meta, Amazon have freezed hiring amid the ongoing layoffs to cut costs. This means freshers have less opportunities as compared to the last 2 years. Moreover, several job claimants have noted that they have received offer letters but they don't have a joining date yet because the companies are trying to renegotiate the contracts and delay the onboarding. This is the case of major Indian IT companies like Infosys, TCS, Wipro, LTI Mindtree, Tech Mahindra, etc. The layoffs have effectively increased the competition in the job market, and experts claim that AI is also going to be detrimental for the Indians in the early phase of their career, since AI tools would be able to do the same tasks in a more efficient and economic way. Back to you.
Well, thanks a lot, Akansha, for all that information, but definitely it's tougher times for the freshers of the IT industry right there. But we're out of time on this edition. Many thanks for tuning in, but do stay tuned on to India Today for a whole lot more coverage on the world of news coming up right up on your screens. Until then, many thanks for tuning in and good night.